Welcome to Al Jazari channel, where you will learn inventory management as a core operations management activity. Effective inventory management is important for the successful operation of most businesses and their supply chains. This is because inventory management impacts operations, marketing, and finance. Poor inventory management hampers operations, diminishes customer satisfaction, and increases operating costs. Here we will discuss the meaning of inventory, recognize its importance, kinds, cost, and classification system. Let us start with the definition of inventory. An inventory is a stock or store of goods. Firms typically stock hundreds or even thousands of items in inventory, ranging from small things such as pencils, paper clips, screws, nuts, and bolts to large items such as machines, cars, trucks, construction equipment, and airplanes. Inventories are a vital part of the business. Not only are they necessary for operations, but they also contribute to customer satisfaction. To get a sense of the significance of inventories, you should know that a typical firm probably has about 30% of its current assets and perhaps as much as 90% of its working capital invested in inventory. One widely used measure of managerial performance relates to return on investment, or ROI, which is profit after taxes divided by total assets. Because inventories may represent a significant portion of total assets, a reduction of inventories can result in a significant increase in ROI. There are different kinds of inventories. This includes raw materials and purchased parts, partially completed goods, called work in process, finished goods inventories, tools and supplies, maintenance and repairs inventory, goods in transit to warehouses, distributors, or customers, or pipeline inventory. For effective inventory management, we should know inventory-related costs. These are: purchase cost is the amount paid to a vendor or supplier to buy the inventory. It is typically the largest of all inventory costs. Holding, or carrying, costs relate to physically having items in storage. Costs include interest, insurance, depreciation, obsolescence, deterioration, spoilage, pilferage, breakage, tracking, picking, and warehousing costs such as light, rent, and security. Holding costs are stated in either of two ways, as a percentage of unit price or as a dollar amount per unit. Ordering costs are the costs of ordering and receiving inventory. They are the costs that vary with the actual placement of an order. Besides shipping costs, they include determining how much is needed, preparing invoices, inspecting goods upon arrival for quality and quantity, and moving the goods to temporary storage. Ordering costs are generally expressed as a fixed dollar amount per order, regardless of order size. When a firm produces its own inventory instead of ordering it from a supplier, machine setup costs are analogous to ordering costs. That is, they are expressed as a fixed charge per production run, regardless of the size of the run. Setup costs are the costs of preparing equipment for the job by adjusting the machine, changing cutting tools, and so on. Shortage costs result when demand exceeds the supply of inventory on hand. These costs can include the opportunity cost of not making a sale, loss of customer goodwill, late charges, back order costs, and similar costs. Another requirement for effective management is the existence of a classification system. Items held in inventory are not of equal importance in terms of dollars invested, profit potential, sales or usage volume, or stockout penalties. It would be unrealistic to devote equal attention to each of these items. Instead, a more reasonable approach would be to allocate control efforts according to the relative importance of various items in inventory. The ABC approach classifies inventory items according to some measure of importance, usually annual dollar value, that is the dollar value per unit multiplied by annual usage rate, and then allocates control efforts accordingly. Typically, three classes of items are used: A, very important; B, moderately important; and C, least important. A items generally account for about 10 to 20% of the number of items in inventory, but about 60 to 70% of the annual dollar value. At the other end of the scale, C items might account for about 50 to 60% of the number of items, but only about 10 to 15% of the dollar value of an inventory. This figure illustrates the ABC concept. To classify inventory items using the ABC approach, follow these steps. For each item, multiply the annual volume by unit price to get the annual dollar. Then, arrange annual dollar values in descending order. At the end, the few, 10 to 15%, with the highest annual dollar value are A items. The most, about 50%, with the lowest annual dollar value are C items. Those in between, about 35%, are B items. Let us solve an example for a better understanding. A manager has obtained a list of unit costs and estimated annual demands for 10 inventory items, as illustrated in this table. Now wants to categorize the items on an ABC basis. Multiplying each item's annual demand by its unit cost yields its annual dollar value. For item 1, 2,500 multiplied by 360 equals 900,000. For item 2, 1,000 multiplied by 70 equals 70,000. For item 3, 2,400 multiplied by 500 equals 1,200,000. Continue in the same way until finishing the whole 10 items. Now calculate the total annual dollar value. Arranging the annual dollar values in descending order can facilitate assigning items to categories. The percentage of the 8th item annual dollar value to the total one is 52.7%. So, it is classified as A. While the percentage of the annual dollar value of items 4, 10, 9, 2, 5, and 7 to the total one is only 6.5%. So, they are classified as C. Of course, the percentage of the annual dollar value of the remaining items 3, 6, and 1 to the total one is 40.8%. So, they are classified as B. Note that category A has the fewest number of items but the highest percentage of annual dollar value. In contrast, category C has the most items but only a small percentage of the annual dollar value. Managers use the ABC concept in many different settings to improve operations. One key use occurs in customer service, where a manager can focus attention on the most important aspects of customer service by categorizing different aspects as very important, important, or of only minor importance. Another application of the ABC concept is as a guide to cycle counting, which is a physical count of items in inventory. The purpose of cycle counting is to reduce discrepancies between the amounts indicated by inventory records and the actual quantities of inventory on hand. Accuracy is important because inaccurate records can lead to disruptions in operations, poor customer service, and unnecessarily high inventory carrying costs. Keep following us. If you did not do yet, subscribe to the Al Jazeera channel and activate the alarm to be notified of the new videos. After discussing the meaning of inventory, and recognizing its importance, kinds, cost, and classification system, let we learn the inventory ordering policies. Inventory ordering policies address the two basic issues of inventory management, which are how much to order and when to order. A number of models are described that are used for these issues. Inventory that is intended to meet expected demand is known as cycle stock, while inventory that is held to reduce the probability of experiencing a stockout, i.e., running out of stock, due to demand and/or lead time variability is known as safety stock. The discussion begins with the issue of how much to order. The question of how much to order can be determined by using an economic order quantity, or EOQ, model. EOQ models identify the optimal order quantity by minimizing the sum of certain annual costs that vary with order size and order frequency. 3 order size models are described here. The basic economic order quantity model, the economic production quantity model, and the quantity discount model. Let us start with the first model. The basic economic order quantity model is the simplest of the 3 models. It is used to identify a fixed order size that will minimize the sum of the annual costs of holding inventory and ordering inventory. The basic model involves a number of assumptions. These are: only one product is involved. The annual demand requirements are known. The demand is spread evenly throughout the year so that the demand rate is reasonably constant. Lead time is known and constant. Each order is received in a single delivery. And there are no quantity discounts. This figure illustrates several inventory cycles. A cycle begins with the receipt of an order of Q units, which are withdrawn at a constant rate over time. When the quantity on hand is just sufficient to satisfy demand during lead time, an order for Q units is submitted to the supplier. Because it is assumed that both the usage rate and the lead time do not vary, the order will be received at the precise instant that the inventory on hand falls to zero. Thus, orders are timed to avoid both excess stock and stockouts. Two of the inventory costs that we studied in the last video are the carrying or holding and ordering costs. Let us focus on these two costs. Annual carrying cost is computed by multiplying the average amount of inventory on hand by the cost to carry 1 unit for 1 year. The average inventory is simply half of the order quantity. The amount on hand decreases steadily from Q units to 0, for an average of Q plus 0 or Q divided by 2. Using the symbol H to represent the average annual carrying cost per unit, the total annual carrying cost is Q multiplied by H divided by 2, where Q is the order quantity in units and H is the holding, or carrying, cost per unit per year. Carrying cost is thus a linear function of Q and directly proportional to changes in the order quantity Q. On the other hand, annual ordering costs will decrease as order size increases because, for a given annual demand, the larger the order size, the fewer the number of orders needed. In general, the number of orders per year will be D divided by Q, where D is the annual demand and Q is the order size. Because the ordering cost is treated as a constant, annual ordering cost is a function of the number of orders per year and the ordering cost per order. So, the annual ordering cost equals D multiplied by S divided by Q, where D is the demand, usually in units per year, and S is the ordering cost per order. Because the number of orders per year, D divided by Q, decreases as Q increases, annual ordering cost is inversely related to order size. The total annual cost associated with carrying and ordering inventory when Q units are ordered each time is TC equals annual carrying cost plus annual ordering cost equals Q multiplied by H divided by 2 plus D multiplied by S divided by Q. The total cost curve is U-shaped or convex, with one minimum, and it reaches its minimum at the quantity where carrying and ordering costs are equal. An expression for the optimal order quantity can be obtained using calculus. The result is the formula Q0 equals the square root of 2 multiplied by D multiplied by S divided by H. Thus, given annual demand, the ordering cost per order, and the annual carrying cost per unit, one can compute the economic order quantity. The minimum total cost is then found by substituting Q0 for Q in the total cost formula. Let us now solve an example. A local distributor for a national tire company expects to sell approximately 9,600 steel-belted radial tires of a certain size and tread design next year. The annual carrying cost is $16 per tire, and the ordering cost is $75. The distributor operates 288 days a year. What is the EOQ? How many times per year does the store reorder? What is the length of an order cycle? What is the total annual cost if the EOQ quantity is ordered? So, the givens are D equals 9,600 tires per year, H equals $16 per unit per year, and S equals $75. We know that EOQ or Q0 equals the square root of 2 multiplied by D multiplied by S divided by H. Substitute by the given values, so Q0 equals 300 tires. To answer the second question, simply divide the annual demand D by the economic order quantity Q0. So, the number of orders per year is D divided by Q0 equals 9,600 divided by 300 equals 32 orders. To find the length of the order cycle, we have to divide Q0 by D and multiply the result by the number of working days in a year. The length of the order cycle equals 300 divided by 9,600 equals 1/32 year. Multiply this result by 288 equals 9 working days. The last question is to calculate the total cost if the EOQ is ordered. We know that TC equals Q0 multiplied by H divided by 2 plus D multiplied by S divided by Q0. Substitute by the given and calculated values. TC equals 300 multiplied by 16 divided by 2 plus 9,600 multiplied by 75 divided by 300 equals $4,800. After solving this example, let us solve a problem. A large bakery buys flour in 25-pound bags. The bakery uses an average of 1,215 bags a year. Preparing an order and receiving a shipment of flour involves a cost of $10 per order. Annual carrying costs are $75 per bag. Determine the economic order quantity. What is the average number of bags on hand? How many orders per year will there be? Compute the total cost of ordering and carrying flour. If holding costs were to increase by $9 per year, how much would that affect the minimum total annual cost? The givens in this problem are the annual demand D equals 1,215, the order cost S equals $10, and the holding cost H equals $75. The first question is, determine the economic order quantity. Recalling the equation used to calculate the economic order quantity. Q0 equals the square root of 2 multiplied by D multiplied by S divided by H. Substitute by the given values of D, S, and H. Q0 equals the square root of 2 multiplied by 1,215 multiplied by 10 divided by 75. This equals 18 bag. So, the economic order quantity equals 18 bags. The second question is, what is the average number of bags on hand? To find the average number of bags on hand, we have to divide Q0 by 2. It is equal to 18 divided by 2 equal 9. So, the average number of bags on hand is 9 bags. The third question is, how many orders per year will there be? Simply, the number of orders per year equals the annual demand divided by the economic order quantity. Equal 1,215 divided by 18 equals 67.5, approximately equals 68 orders. So, the number of orders per year is 68 orders. The next question is, compute the total cost of ordering and carrying flour. The total cost TC equals Q multiplied by H divided by 2 plus D multiplied by S divided by Q. Substitute by the given values of D, S, and H, and the calculated value of Q0. This results in TC equals 18 multiplied by 75 divided by 10 plus 1,215 multiplied by 10 divided by 18 equal $1,350. So, the total cost of ordering and carrying flour is $1,350. The last question is to find the change in the minimum total cost if the holding cost increased by $9, which means that H is $84 instead of $75. To answer this, we have to recalculate the Q0 corresponding to the new value of H. So, Q0 equals the square root of 2 multiplied by D multiplied by S divided by H equals the square root of 2 multiplied by 1,215 multiplied by 10 divided by 85. This equals 17 bags. And the corresponding minimum total cost is TC equals 17 multiplied by 84 divided by 10 plus 1,215 multiplied by 10 divided by 17 equal $1,429. This value is higher than the previous one by $79. Consequently, if the holding cost increases by $9, the minimum total cost will increase by $79. One solved example is explained and another problem is solved to illustrate the basic economic order quantity model. If you need more details or more solved problem, do not hesitate to contact me. If you did not do yet, subscribe to the Al Jazari channel and activate the alarm to be notified of the new videos. After learning the basic economic order quantity model, let us solve some problems. A food processor uses approximately 25,000 glass jars a month for its fruit juice product. Because of storage limitations, a lot size of 6,000 jars has been used. Monthly holding cost is 5 cents per jar, and reordering cost is $100 per order. The company operates an average of 20 days a month. What penalty is the company incurring by its present order size? The manager would prefer ordering 5 times each month but would have to justify any change in order size. One possibility is to simplify order processing to reduce the ordering cost. What ordering cost would enable the manager to justify ordering every 4 days, i.e., 5 times a month? The given are, the monthly demand D equal 25,000 jars, the order quantity Q equals 6,000 jars, the carrying cost H equals 5 cents, and the order cost S equals $100. To know the penalty the company is incurring by its present order size, we have to calculate the total cost corresponding to the current order quantity Q and compare it with the total cost corresponding to the economic order quantity Q0. We know that TC equals Q multiplied by H divided by 2 plus D multiplied by S divided by Q. Substitute by the given values. TC 6000 equals 6000 multiplied by 0.05 divided by 2 plus 25,000 multiplied by 100 divided by 6000 equal 150 plus 416.7 equals $566.70. The next step is to calculate the economic order quantity Q0. We know that EOQ or Q0 equals the square root of 2 multiplied by D multiplied by S divided by H. Substitute by the given values, so Q0 equals the square root of 2 multiplied by 25,000 multiplied by 100 divided by 0.05 equal 10,000 jars. Now calculate the total cost corresponding to the economic order quantity Q0. TC 10,000 equals 10,000 multiplied by 0.05 divided by 2 plus 25,000 multiplied by 100 divided by 10,000 equal 250 plus 250 equals $500. Comparing the total cost corresponding to the current order quantity Q and the total cost corresponding to the economic order quantity Q0. Total cost corresponding to the current order quantity Q is more than that corresponding to Q0 by $66.70. So, the penalty the company incurring by its present order size is $66.70 per month. For the second question, to find the ordering cost that would enable the manager to justify ordering every 4 days, we have to solve the total cost equation to find S using TC equals TC 6000 and Q equals 5000 as the monthly demand equal 25,000 and the number of orders is 5. So, 566.7 equals 5000 multiplied by 0.05 divided by 2 plus 25,000 multiplied by S divided by 5000. Solving this equation results in S equals $88.34. So, the ordering cost would enable the manager to justify ordering 5 times a month as $88.34. Another problem. A manager receives a forecast for next year. Demand is projected to be 600 units for the first half of the year and 900 units for the second half. The monthly holding cost is $2 per unit, and it costs an estimated $55 to process an order. Assuming that monthly demand will be level during each of the 6-month periods covered by the forecast, example 100 per month for each of the first 6 months, determine an order size that will minimize the sum of ordering and carrying costs for each of the 6-month periods. Why is it important to be able to assume that demand will be level during each 6-month period? If the vendor is willing to offer a discount of $10 per order for ordering in multiples of 50 units, example 50, 100, 150, would you advise the manager to take advantage of the offer in either period? If so, what order size would you recommend? The given are: demand is projected for the first half of the year to be D1 equals 600 units and for the second half D2 equals 900 units. The monthly holding cost is H equals $2 per unit per month, and the order cost S equals $55 per order. Note, we will solve this problem using months, rather than a year, as the period. For the first question, starting by the first 6-month period. The monthly demand D1 equals 600 divided by 6 equals 100 units. It is known that Q0 equals square root of 2 multiplied by D1 multiplied by S divided by H. This equals square root of 2 multiplied by 100 multiplied by 55 divided by 2 equals 74.16 approximately equals 74 units. So, the economic order quantity for the first 6 months is 74 units. For the second 6-month period, the monthly demand D2 equals 900 divided by 6 equals 150 units. And Q0 equals square root of 2 multiplied by D2 multiplied by S divided by H. This equals square root of 2 multiplied by 150 multiplied by 55 divided by 2 equal 90.83 approximately equal 91 units. So, the economic order quantity for the second 6 months is 91 units. The second question is, why is it important to be able to assume that demand will be level during each 6-month period? The answer is, because we can use the economic order quantity only if demand is level or stable. The last question is if the vendor is willing to offer a discount of $10 per order for ordering in multiples of 50 units, example 50, 100, 150, would you advise the manager to take advantage of the offer in either 6-month period? If so, what order size would you recommend? To solve this question, we have to calculate the total cost corresponding to Q0, 50, 100, and 150 for each period and select the quantity that give minimum total cost. Generally, the total cost TC equals Q multiplied by H divided by 2 plus D multiplied by S divided by Q. For the first 6-month period, the monthly total cost corresponding to Q0 equals 74 is TC 74 equals 74 multiplied by 2 divided by 2 plus 100 multiplied by 55 divided by 74 equal $148.32. With discount of $10, S equals $55 minus $10 equals $45. So, the monthly total cost corresponding to Q equals 50 is TC 50 equals 50 multiplied by 2 divided by 2 plus 100 multiplied by 45 divided by 50 equal $140. The monthly total cost corresponding to Q equals 100 is TC 100 equals 100 multiplied by 2 divided by 2 plus 100 multiplied by 45 divided by 100 equal $145. And the monthly total cost corresponding to Q equals 150 is TC 150 equals 150 multiplied by 2 divided by 2 plus 100 multiplied by 45 divided by 150 equal $180. As the total cost at quantity equal to 50 unit has the minimum value. So, for the first period the question answer is yes, the manager should take advantage of the offer and order Q equals 50 units during this 6-month period. For the second 6-month period, the monthly total cost corresponding to Q0 equals 91 is TC 91 equals 91 multiplied by 2 divided by 2 plus 150 multiplied by 55 divided by 91 equal $181.66. With discount of $10, S equals $55 minus $10 equals $45. So, the monthly total cost corresponding to Q equals 50 is TC 50 equals 50 multiplied by 2 divided by 2 plus 150 multiplied by 45 divided by 50 equal $185. The monthly total cost corresponding to Q equals 100 is TC 100 equals 100 multiplied by 2 divided by 2 plus 150 multiplied by 45 divided by 100 equal $167.50. And the monthly total cost corresponding to Q equals 150 is TC 150 equals 150 multiplied by 2 divided by 2 plus 150 multiplied by 45 divided by 150 equal $195. As the total cost at quantity equal to 100 unit has the minimum value. So, for the second period the question answer is yes, the manager should take advantage of the offer and order Q equals 100 units during this 6-month period. Here two problems are solved as application of the basic economic order quantity model. If you need more details or more solved problem, do not hesitate to contact me. If you like this video, so press like and share it, and do not forget to subscribe to the Al Jazari channel and activate the alarm to be notified of the new videos. Economic production quantity model will be discussed. This model is used in batch production mode. This model is widely used in production. Even in assembly operations, portions of the work are done in batches. The reason for this is that in certain instances, the capacity to produce a part exceeds the part's usage or demand rate. As long as production continues, inventory will continue to grow. In such instances, it makes sense to periodically produce such items in batches, or lots, instead of producing continually. The economic production quantity model has the same assumption as the economic production quantity model, except that instead of orders received in a single delivery, units are received incrementally during production. The assumptions are: only one product is involved. The annual demand requirements are known. The usage rate is constant. The usage occurs continually, but production occurs periodically. The production rate is constant. Lead time does not vary. And there are no quantity discounts. This figure illustrates how inventory is affected by periodically producing a batch of a particular item. During the production phase of the cycle, inventory builds up at a rate equal to the difference between production and usage rates. For example, if the daily production rate is 20 units and the daily usage rate is 5 units, inventory will build up at the rate of 20 minus 5 equals 15 units per day. As long as production occurs, the inventory level will continue to build. When production ceases, the inventory level will begin to decrease. Hence, the inventory level will be maximum at the point where production ceases. When the amount of inventory on hand is exhausted, production is resumed, and the cycle repeats itself. Because the company makes the product itself, there are no ordering costs as such. Nonetheless, with every production run, or batch, there are setup costs. That is the costs required to prepare the equipment for the job, such as cleaning, adjusting, and changing tools and fixtures. Setup costs are analogous to ordering costs because they are independent of the run size. They are treated in the formula in exactly the same way. The larger the run size, the fewer the number of runs needed and, hence, the lower the annual setup cost. The number of runs or batches per year is the annual demand, D, divided by the run size, Q, and the annual setup cost is equal to the number of runs per year times the setup cost, S, per run. So, the annual setup cost equals D multiplied by S divided by Q. Consequently, the total cost is TC equals annual carrying cost plus annual ordering cost equals I maximum multiplied by H divided by 2 plus D multiplied by S divided by Q, where I maximum is the maximum inventory. Using calculus, the economic production quantity is QP equals the square root of 2 multiplied by D multiplied by S divided by H multiplied by the square root of P divided by P minus U, where P is the production or delivery rate and U is the usage rate. The cycle time, which is the time between orders or between the beginnings of runs, for the economic run size model is a function of the run size and usage or demand rate. So, the cycle time equals QP divided by U. Similarly, the run time, or the production phase of the cycle, is a function of the run size and the production rate. Hence, the run time equals QP divided by P. The maximum inventory level, I maximum equals QP divided by P multiplied by P minus U. And the average inventory level, I average equals I maximum divided by 2. Let us now solve an example. A toy manufacturer uses 48,000 rubber wheels per year for its popular dump truck series. The firm makes its own wheels, which it can produce at a rate of 800 per day. The toy trucks are assembled uniformly over the entire year. The carrying cost is $1 per wheel a year. The setup cost for a production run of wheels is $45. The firm operates 240 days per year. Determine the optimal run size, the maximum inventory, the minimum total annual cost for carrying and setup, the cycle time for the optimal run size, the run time. So, the givens are: the demand, D equals 48,000 wheels per year. The setup cost, S equals $45. The carrying cost, H equals $1 per wheel per year. The production rate, P equals 800 wheels per day. The number of working days per year is 240 days. To find the usage rate, U, we have to divide D by the number of working days equals 48,000 divided by 240 equals 200 wheels per day. For the first question, we know that the optimal run size is the EPQ equals QP equals the square root of 2 multiplied by D multiplied by S divided by H multiplied by the square root of P divided by P minus U. Substitute by the given values, so QP equals the square root of 2 multiplied by 48,000 multiplied by 45 divided by 1 multiplied by the square root of 800 divided by 800 minus 200 equal 2,400 wheels. The second question is to find the maximum inventory, which equals QP divided by P multiplied by P minus U equals 2400 divided by 800 multiplied by 800 minus 200 equals 1800 wheels. The third question is to determine the minimum total annual cost for carrying and setup. TC minimum equals I maximum multiplied by H divided by 2 plus D multiplied by S divided by QP equal 1800 multiplied by 1 divided by 2 plus 48,000 multiplied by 45 divided by 2400 equals $1,800. The fourth question is to calculate the cycle time for the optimal run size, that equals the optimal run size divided by the usage rate, or QP divided by U equals 2400 divided by 200 equal 12 days. While the last question is to find the runtime, that can be calculated by dividing the optimal run size by the production rate, or QP divided by P equals 2400 divided by 800 equals 3 days. Let us now solve a problem. A chemical firm produces sodium bisulfate in 100-pound bags. The demand for this product is 20 tons per day. The capacity for producing the product is 50 tons per day. The setup costs $100, and the handling costs are $5 per ton a year. The firm operates 200 days a year. Note, 1 ton equals 2,000 pounds. Answer the following questions. How many bags per run are optimal? What would the average inventory be for this lot size? Determine the approximate length of a production run, in days. About how many runs per year would there be? The givens of this problem are: 1 bag weighs 100 pounds, the demand, or usage rate equals 20 tons per day, the production rate is 50 tons per day, the setup cost equals $100 and the carrying cost is $5. The first question is to find the number of bags per run for optimal cost. It is known that the optimal run size is the EPQ equals QP equals the square root of 2 multiplied by D multiplied by S divided by H multiplied by the square root of P divided by P minus U. To find QP, we have to calculate the demand, D, first, where D equals the usage rate, U, multiplied by the number of working days in a year. That is equal to 20 multiplied by 200 equals 4,000 tons. Now we can find QP by substituting by the given values, so QP equals the square root of 2 multiplied by 4,000 multiplied by 100 divided by 5, multiplied by the square root of 50 divided by 50 minus 20 equals 516 tons. To convert this value to bags, multiply it by 2,000 and divide by 100, because 1 ton contains 2,000 pounds and 1 bag contains 100 pounds. This equals 10,320 bags. The second question is, what would the average inventory be for this lot size? We know that the average inventory equals the maximum inventory divided by 2, and the maximum inventory equals QP divided by P multiplied by P minus U. So, I maximum equals 516 divided by 50 multiplied by 50 minus 20 equals 309.6 tons. Consequently, the average inventory equals 309.6 divided by 2 equals 154.8 tons. The third question is to determine the approximate length of a production run, in days. The length of the production run equals QP divided by P equals 516 divided by 50 equals 10.32, approximately equal to 10 days. The last question is to find the number of runs per year. To determine the number of runs per year, simply divided the demand, D, by the economic production quantity, QP, which is equal to 4,000 divided by 516 equals 7.75, approximately equals 8 runs. One solved example is explained and another problem is solved to illustrate the economic production quantity model. If you need more details or more solved problem, do not hesitate to contact me. If you did not do yet, subscribe to the Al Jazeera channel and activate the alarm to be notified of the new videos. The quantity discount model will be discussed. Quantity discounts are price reductions for larger orders offered to customers to induce them to buy in large quantities. For example, a surgical supply company publishes the price list shown in this table for boxes of gauze strips. Note that the price per box decreases as order quantity increases. If quantity discounts are offered, the buyer must weigh the potential benefits of reduced purchase price and fewer orders that will result from buying in large quantities against the increase in carrying costs caused by higher average inventories. The buyer's goal with quantity discounts is to select the order quantity that will minimize total cost, where total cost is the sum of carrying cost, ordering cost, and purchasing cost. Thus, TC equals Q multiplied by H divided by 2 plus D multiplied by S divided by Q plus P multiplied by D, where P is the unit price. When quantity discounts are offered, there is a separate U-shaped total cost curve for each unit price. Including unit prices merely raises each curve by a constant amount. However, because the unit prices are all different, each curve is raised by a different amount. Smaller unit prices will raise a total cost curve less than larger unit prices. Note that no one curve applies to the entire range of quantities, each curve applies to only a portion of the range as illustrated by solid lines in this figure. Hence, the applicable or feasible total cost is initially on the curve with the highest unit price and then drops down, curve by curve, at the price breaks, which are the minimum quantities needed to obtain the discounts. Even though each curve has a minimum, those points are not necessarily feasible. For example, the minimum point for the $1.40 curve appears to be about 65 units. However, the price list indicates that an order size of 65 boxes will involve a unit price of $1.70. The actual total cost curve is denoted by the solid lines. Only those price, quantity combinations are feasible. The objective of the quantity discount model is to identify the order quantity that will represent the lowest total cost for the entire set of curves. Let us now solve an example. The maintenance department of a large hospital uses about 816 cases of liquid cleanser annually. Ordering costs are $12, carrying costs are $4 per case a year, and the new price schedule indicates that orders of less than 50 cases will cost $20 per case. 50 to 79 cases will cost $18 per case, 80 to 99 cases will cost $17 per case, and larger orders will cost $16 per case. Determine the optimal order quantity and the total cost. The givens are, the demand D equals 816 case per year, the order cost S equals $12 per order, the carrying cost H equals $4 per case per year, and the purchasing price is illustrated in the table. The first step in solving this problem is to find the common minimum Q, which equals the square root of 2 multiplied by D multiplied by S divided by H. Substitute by the given values. Q equals the square root of 2 multiplied by 816 multiplied by 12 divided by 4 equals 69.97, approximately equals 70 cases. The next step is to calculate the total cost corresponding to Q equals 70. At this quantity the unit price is $18 per case, as 70 falls in the range of 50 to 79 case. Known that TC equals Q multiplied by H divided by 2 plus D multiplied by S divided by Q plus P multiplied by D. So, the total cost at Q equals 70, TC 70 equals 70 multiplied by 4 divided by 2 plus 816 multiplied by 12 divided by 70 plus 18 multiplied by 816 equals $14,968. Because lower cost ranges exist, each must be checked against the minimum cost generated by 70 cases at $18 each. In order to buy at $17 per case, at least 80 cases must be purchased. Thus, the total cost at 80 cases will be, TC 80 equals 80 multiplied by 4 divided by 2 plus 816 multiplied by 12 divided by 80 plus 17 multiplied by 816 equals $14,154. To obtain a cost of $16 per case, at least 100 cases per order are required, and the total cost at that price break will be, TC 100 equals 100 multiplied by 4 divided by 2 plus 816 multiplied by 12 divided by 100 plus 16 multiplied by 816 equals $13,354. Because 100 cases per order yields the lowest total cost, so, ordering a quantity of 100 cases per order is the overall optimal order quantity. And the corresponding total cost is $13,354. Let us now solve a problem. A mail order house uses 18,000 boxes a year. Carrying costs are 60 cents per box a year, and ordering costs are $96. The following price schedule applies. Determine the optimal order quantity and the number of orders per year. The givens are: the demand D equals 18,000 boxes per year, the order cost S equals $96 per order, the carrying cost H equals 60 cents per box per year, and the purchasing price is illustrated in the table. The first step in solving this problem is to find the common minimum Q, which equals the square root of 2 multiplied by D multiplied by S divided by H. Substitute by the given values. Q equals the square root of 2 multiplied by 18,000 multiplied by 96 divided by 0.6 equals 2,400 boxes. The next step is to calculate the total cost corresponding to Q equal 2,400. At this quantity the unit price is $1.20 per box, as 2,400 falls in the range of 2,000 to 4,999 boxes. Known that TC equals Q multiplied by H divided by 2 plus D multiplied by S divided by Q plus P multiplied by D. So, the total cost at Q equal 2,400, TC 2,400 equals 2,400 multiplied by 0.6 divided by 2 plus 18,000 multiplied by 96 divided by 2,400 plus 1.2 multiplied by 18,000 equals $23,040. Because lower cost ranges exist, each must be checked against the minimum cost generated by 2,400 cases at $1.20 each. In order to buy at $1.15 per box, at least 5,000 boxes must be purchased. Thus, the total cost at 5,000 cases will be TC 5,000 equals 5,000 multiplied by 0.6 divided by 2 plus 18,000 multiplied by 96 divided by 5,000 plus 1.15 multiplied by 18,000 equals $22,545.60. To obtain a price of $1.10 per box, at least 10,000 boxes per order are required, and the total cost at that price break will be TC 10,000 equals 10,000 multiplied by 0.6 divided by 2 plus 18,000 multiplied by 96 divided by 10,000 plus 1.1 multiplied by 18,000 equals $22,927.80. Because 5,000 boxes per order yields the lowest total cost, so ordering a quantity of 5,000 boxes is the overall optimal order quantity. To find the number of orders per year, simply divide the yearly demand by the optimal order quantity. That is equal 18,000 divided by 5,000 equal 3.6 order. One solved example is explained and another problem is solved to illustrate the quantity discount model. So, the question, how much to order, is answered. If you need more details or more solved problem, do not hesitate to contact me. Hopefully, you can make use the economic order quantity models by yourself. If you like this video, so press like and share it. And do not forget to subscribe to the channel and activate the alarm to be notified of the new videos. Here the answer of the question, when to order, is explained. The answer of this question is the function of models that identify the reorder point, ROP, in terms of a quantity. The reorder point occurs when the quantity on hand drops to a predetermined amount. That amount generally includes expected demand during lead time. There are 4 determinants of the reorder point quantity. The rate of demand, usually based on a forecast. The lead time. The extent of demand and or lead time variability. And the degree of stockout risk acceptable to management. There are 2 situations while calculating the reorder point. The first, when the demand and lead time are both constant, while the second situation variability is present in demand and or lead time. In the first situation, the reorder point is simply ROP equals D multiplied by LT, where D is the demand rate, units per day or week. LT is the lead time in days or weeks. Note that demand and lead time must be expressed in the same time units. Example: a copy center uses 12 boxes of copy paper a week. The lead time is 4 days. Knowing that they work 6 days a week, calculate the reorder point. The given are the demand rate D equals 12 boxes per week and the lead time LT equals 4 days. Demand and lead time must be expressed in the same time units, So D must be divided by 6 to convert week into day, as 1 week equals 6 working days. So, D equals 12 divided by 6 equals 2 boxes per day. Now we can calculate the ROP, which equals D multiplied by LT equals 2 multiplied by 4 equal 8 boxes. This means that the copy center should make an order once they have 8 boxes on hand. When there is variability in demand or lead time, it creates the possibility that actual demand will exceed expected demand and causing stockout. Consequently, it becomes necessary to carry additional inventory, called safety stock, to reduce the risk of running out of inventory during lead time. The reorder point then increases by the amount of the safety stock. So, ROP equals expected demand during lead time plus safety stock. The shown figure illustrates how safety stock can reduce the risk of a stockout during lead time. Note that stockout protection is needed only during lead time. If there is a sudden surge at any point during the cycle, that will trigger another order. Once that order is received, the danger of an imminent stockout is negligible. Because it costs money to hold safety stock, a manager must carefully weigh the cost of carrying safety stock against the reduction in stockout risk it provides. The customer service level increases as the risk of stockout decreases. Order cycle service level can be defined as the probability that demand will not exceed supply during lead time, which means that the amount of stock on hand will be sufficient to meet demand. Hence, a service level of 95% implies a probability of 95% that demand will not exceed supply during lead time. The risk of a stockout is the complement of service level. That is, service level equals 100% minus stockout risk. Let us look at several models that can be used in cases when variability is present. The first model can be used if an estimate of expected demand during lead time and its standard deviation are available. The formula is ROP equals expected demand during lead time plus Z multiplied by sigma DLT, where Z is the number of standard deviations and sigma DLT is the standard deviation of lead time demand. The models generally assume that any variability in demand rate or lead time can be adequately described by a normal distribution. The value of Z used in a particular instance depends on the stockout risk that the manager is willing to accept. Generally, the smaller the risk the manager is willing to accept, the greater the value of Z. An example for this model. Suppose that the manager of a construction supply house determined from historical records that demand for sand during lead time averages 50 tons. In addition, suppose the manager determined that demand during lead time could be described by a normal distribution that has a mean of 50 tons and a standard deviation of 5 tons. Answer these questions, assuming that the manager is willing to accept a stockout risk of no more than 3%. What value of Z is appropriate? How much safety stock should be held? What reorder point should be used? The given or expected lead time demand equals 50 tons, sigma DLT equals 5 tons, and the stockout risk 3%. To solve the first question, we have to calculate the service level first, which equal 100 minus the stockout risk that equals 100 minus 3 equal 97% equal 0.97. So, in this table find the closest value to 0.97, here it is. Then, find the corresponding value of Z by looking to the row and column heading. So, Z equals 1.8 plus 0.08 equal 1.88. So, the appropriate value of Z is 1.88. The second question is, how much safety stock should be held? We know that the safety stock equals Z multiplied by sigma DLT, equal 1.88 multiplied by 5 equal 9.4 tons. The third question is, what reorder point should be used? The reorder point equals expected demand during lead time plus safety stock. This equals 50 plus 9.4 equals 59.4 tons. When data on lead time demand are not readily available, the previous model cannot be used. Nevertheless, data are generally available on daily or weekly demand, and on the length of lead time. Using those data, a manager can determine whether demand or lead time is variable, if variability exists in one or both, and the related standard deviation. For those situations, one of the following models can be used. If only demand is variable, then sigma DLT equals sigma D multiplied by square root of LT, and the reorder point is ROP equals d bar multiplied by LT plus Z multiplied by sigma D multiplied by square root of LT. Where d bar is the average daily or weekly demand, sigma D is the standard deviation of demand per day or week, and LT is the lead time in days or weeks. While, if only lead time is variable, then sigma DLT equals d multiplied sigma LT, and the reorder point is ROP equals d multiplied by LT bar plus Z multiplied by d multiplied by sigma LT. Where d is the daily or weekly demand, LT bar is the average lead time in days or weeks, and sigma LT is the standard deviation of lead time in days or weeks. And if both demand and lead time are variable, then sigma DLT equals square root of LT bar multiplied by sigma D square plus d bar square multiplied by sigma LT square. And the reorder point is ROP equals d bar multiplied by LT bar plus Z multiplied by square root of LT bar multiplied by sigma D square plus d bar square multiplied by sigma LT square. Let us solve an example. A restaurant uses an average of 50 jars of a special sauce each week. Weekly usage of sauce has a standard deviation of 3 jars. The manager is willing to accept no more than a 10% risk of stockout during lead time, which is 2 weeks. Assume the distribution of usage is normal. Which of the above models is appropriate for this situation? Why? Determine the value of Z. Determine the ROP. The given are, the average demand D bar equals 50 jars per week, sigma D equals 3 jars, stockout risk equals 10% and the lead time LT equals 2 weeks. The answer of the first question is the second model, demand variation model, is the appropriate one because average demand, D bar, and demand standard deviation, sigma D, are given. To solve the second question, we have to find the service level first, which equals 100 minus the stockout risk equals 100 minus 10 equal 90% equals 0.9. In this table find the closest value to 0.9, then find the corresponding value of Z. We obtain Z equals 1.28. To find the ROP we have to use this equation. So, ROP equals 50 multiplied by 2 plus 1.28 multiplied by 3 multiplied by square root of 2 equal 105.43. Because the inventory is discrete units, jars, we round this amount to 106. Here the issue of when to order is explained using examples. If you like this video, so press like and share it. In this video, an introduction to the inventory is given. Moreover, 3 major models that are used in inventory management were explained and related problems were solved. More inventory management models were explained in different videos available in the playlist with the above link. More operation management topics will be available soon, so keep following us and do not forget to subscribe to the channel and activate the alarm to be notified of the new videos. See you again.